Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
It's great to be here.
Usually when we sit down for these deep dives, we're looking for, I guess, a single thread, maybe a tech trend or a political shift.
One big idea.
But today, looking at the research in front of us, it feels less like a thread and more like a tectonic shift. We're looking at two huge stories that, on the surface, seem miles apart.
They do. At first glance, they seem totally disconnected.
Right. One is about car sales in Germany, literally counting hatchbacks on the Autobahn.
And the other is about the internal playbook of a giant pension fund down in Australia.
But when you actually dig into the numbers, which we're about to do, they're screaming the exact same message.
They really are. It is Thursday, February 5th, 2026.
And just for context, President Trump is back in the White House. The global trade map is, well, it's being redrawn with new tariffs and treaties.
And investors are scrambling to figure out the new rules of the game.
And the theme today, it really feels like the honeymoon is over. It's time for results.
Yeah, the show me year.
Exactly. So we're going to dive into a statistic from the German auto market that honestly had my jaw on the floor. And then we're cracking open the 2026 strategy of Australian Super to see where the smart money is hiding its billions.
And just to be clear for everyone listening, everything we're discussing today comes from analyzing recent market data and reviewing global investment reports. We're just looking at the hard numbers.
So let's start with the cars. And I want to set the scene here because I think for a lot of our American listeners, the German car market might just sound like, luxury cars.
Yeah.
But it is so much more than that.
Oh, it's the boss level of the auto industry.
Exactly. It's the home of the automobile. Mercedes, BMW, Volkswagen. German consumers are incredibly patriotic about their brands, and they are notoriously picky.
They care about things we don't even think about. The sound a door makes when it closes.
Right. Panel gaps, high-speed stability.
Yeah.
The point is, if you can win in Germany, you can win anywhere.
It's a fortress, and breaking into that market as an outsider is, historically, it's almost impossible.
Which is why this data from January 2026, I made just last month, is so shocking.
Yeah, get ready for this.
We're looking at registration numbers. In January, BYD, the Chinese EV giant, registered approximately 2,629 vehicles in Germany.
Now, hearing that number alone, 2,600 cars, it might not sound like an invasion.
It sounds small.
Right.
But you have to look at the trend line. Compare that to January of last year, 2025.
What was it then?
They only sold about 235 cars.
Yeah.
So we're talking about a more than 10 times increase in 1 year.
10x. That's exponential growth.
But here's the kicker. This is the stat that made me do a double take. In that same month, January 2026, Tesla,
the supposed king of EVs,
only registered 1,301 vehicles.
That's the headline right there.
BYD sold double what Tesla did in Germany, on the home turf of the luxury car. How is that even possible?
It's a stunning upset. How do I put this? Imagine it's Oktoberfest in Munich.
Okay.
Everyone's drinking the local world-famous German beer. It's part of their identity.
Right, for centuries.
Then suddenly, a brand new brewery from overseas shows up, sets up a tent, and in the first month, they outsell the biggest, most famous beer brand in the world, 2-1.
That really puts it in perspective. This isn't just a blip on the radar.
No, it signals that the product has moved from being, a cheap alternative to a mainstream contender.
So people aren't just buying it because it's cheap anymore.
They're buying it because they think it's a good car. Full stop.
But I have to ask, why now? I mean, we've known Chinese EVs were coming. What was the catalyst in January specifically? Was it just a lucky month?
No, this wasn't luck. It was a perfect storm of timing and readiness. We have to look at the policy landscape over in Germany.
Okay, walk us through that.
So back in 2023, 2024, the German government, they just abruptly ended their EV subsidies.
Put it off the tap.
Yep. And demand just crashed. They called it the EV winter.
I remember reading about that. Dealers were stuck with cars they couldn't move.
It was brutal. But here in 2026, the government realized, we're falling behind on our climate goals. So they pushed new subsidies. But this time, they were very specific. They targeted low to mid income buyers, the working class.
Okay, so the government rings the dinner bell again. Come and get your discounts.
Right. But here's the critical difference. When that demand window opened back up, who was ready?
Not the Europeans.
The European manufacturers Volkswagen, Stellantis, they were still licking their wounds from the winter. They were struggling with supply chains, software issues.
And Tesla.
Tesla's been dealing with a bit of product fatigue. I mean, the Model Y has been around for a while without a big refresh, but BYD,
They were just waiting.
they were sitting there with the engine running. They had stock on the ground in German ports. They had a dealer network set up. They had affordable cars ready to drive off the lot that day.
I want to touch on that dealer network point. Because for years, the narrative was that the future was direct-to-consumer.
Like Tesla, yeah.
You buy it on an app, it shows up. But you're saying having actual physical car dealerships helped BYD.
In Germany, absolutely. You have to understand the culture. The German car buyer wants to look you in the eye. They want to kick the tires.
I want to know where to take it if it breaks.
Exactly. BYD got that. They built partnerships with local dealer groups. Tesla stuck to its digital model, and the legacy Germans were just too slow.
So BYD won on old school execution, on logistics.
Precisely. Execution beats innovation when the market is ready to buy, and this just shifts the whole competitive landscape. For 5 years, the story was Tesla versus Europe.
Right.
Now, it's China versus everyone.
And looking at the reports, it's not just Germany, is it?
No. Recent data shows Tesla is struggling in France and the Netherlands. Their market share is eroding across the continent.
So let's play this out. Does this mean the German luxury brands are doomed? Or are we going to see everyone trading in their Mercedes for a Chinese hatchback?
I wouldn't go that far yet. The German giants, Mercedes, BMW, they still own the premium segment.
The status symbol.
The badge is a moat. If you want a car to blast down the Autobahn at 150 miles per hour, you're still buying German. But the battle now is for the mass market.
The middle class.
Yeah, the family that needs a reliable car for school and work. For that buyer, cost of ownership is king. Inflation is still an issue. People are budget conscious. And right now, the Chinese have a structural advantage on cost.
Because they make their own batteries.
They own the whole supply chain. Batteries, mining, refining, it lets them price their cars incredibly aggressively.
Oh, wait, what about tariffs? I mean, the trade environment is tense. President Trump is big on tariffs. The EU has its own. How is BYD getting around that?
That's the so what of this whole story. The tariffs are actually accelerating the very thing they were designed to prevent.
How?
Well, because of those trade barriers, it's getting too expensive to just ship cars on boats anymore.
The tax eats up the profit.
Exactly. So what do? They're incentivized to build factories inside Europe. They're localizing.
Ah, I see. So if you build the BYD in, say, Hungary, it counts as a European car.
In many ways, yes. It avoids the political friction. It's like a Trojan horse, but everyone can see it coming. It's no longer about export. It's about becoming a local player.
That's fascinating. You just move to where the rules don't apply to you.
Yeah.
But I saw another detail in the reports that I found really curious. While BYD is crushing it in Germany, their sales inside China actually dropped.
Yes, for 5 months straight. And that is a crucial piece of the puzzle. The price war inside China is just brutal. It's a race to the bottom.
Too many companies fighting for the same customers.
So many. And they're all cutting prices until it hurts their bleeding margin. So for a company like BYD, exporting to Europe acts as a safety valve. They need these foreign markets where they can charge a bit more just to maintain their profits because the competition at home is eating them alive.
So Germany gets the cars because China has too many.
In a way, yeah. They're exporting their way out of a domestic problem. And that desperation, well, it makes them very aggressive competitors.
Okay, so that's the situation on the roads. A massive shakeup. The underdog is winning by just showing up with the goods.
Right.
Now I want to pivot to the money. Because if the car market is changing this fast, how on earth are investors supposed to keep up?
It is the billion-dollar question.
And we have some amazing insights here from Paul Schroeder. He's the CEO of Australian Super. Now, for our listeners who might not know them, Australian Super sounds like a superhero, but it's a pension fund, right?
It is, but they do have a superpower, the power of massive capital.
Oh.
I mean, think of a whale in a swimming pool. They're a pension fund managing hundreds of billions of dollars. These aren't day traders trying to make a quick buck.
They're managing retirement savings for a whole country.
So they have to be conservative. They're the smart money. When they move with the weight of an elephant, and they're planning for decades out. So when they change strategy, we should all pay attention.
And their latest outlook for 2026 has some really interesting points. The first one they talked about is, of course, artificial intelligence.
Can't avoid it.
But they didn't sound like the typical tech bros you see online.
Their view is very realist. Their perspective is that AI has moved out of the buzzword phase. We're just saying AI made your stock go up and into the CapEx cycle.
CapEx, capital expenditure. For those of us who aren't accountants, what does that actually mean?
Think of it like a home renovation, but for a business. It's spending real money on physical stuff, buildings, equipment, hardware. It's the building phase.
Give us a sense of the scale here. Are we talking millions?
Oh, we are way, way past millions. Look at Alphabet, Google's parent company. Their guidance for 2026 is to spend between 175 and 185 billion dollars on CapEx.
Wait, pause there. Nearly $200 billion in 1 year.
Just for infrastructure. Data centers, custom chips, power grids, cooling systems.
That's the GDP of a small country. That's more than the Apollo moon landing program, isn't it?
Adjusted for inflation, yeah, it's in that ballpark. It is staggering. And Australian Super's point is that we are in the infrastructure phase.
Like the gold rush.
Exactly like the gold rush in the 1800s. Right now, we're not finding the gold nuggets yet. We're building the railroads to get to the mine. We're selling the shovels. We're spending fortunes laying the tracks.
So what does that mean for a regular investor listening to this? The instinct for years has been buy tech, number go up. Does that still hold?
No, that's the warning. The phase where a rising tide lifts all boats, that's over. Now it's about picking winners. It's about finding companies with actual moats.
Moats, like around a castle.
Exactly. Real defensive advantages. You can't just have a cool chatbot anymore. To survive this, you need proprietary data nobody else has. You need distribution networks like BYD's dealers, actually. And most importantly, you need massive, massive cash flow.
Because building these data centers is so expensive.
Incredibly expensive.
Yeah.
If you don't have the cash to burn on $180 billion of infrastructure, you get left behind. It's becoming a game for giants.
So it's getting harder to play the game.
Much harder. Selection matters now more than ever.
Now, speaking of playing the game, let's talk geography. I thought this was interesting. Australian Super keeps about 35% of their money in the U.S. market. Even with everything going on, they're still betting big on America. Why?
They view the U.S. market as a compounding engine.
A compounding engine. Unpack that for us.
Well, despite all the political noise, the U.S. is still where the best innovation happens. But more importantly, it's where capital gets recycled most efficiently.
Recycled?
Think about it. A U.S. company makes money. What do? They buy back their own stock. They pay dividends. They reinvest in R&D. It's a machine designed to grow value for shareholders.
Whereas in other places, that money might just sit there.
Or the government might take a bigger cut. The U.S. system is it's optimized for the investor. So even with the risks, the American machine is too efficient to ignore.
Okay, but 35% is a lot. But it's not everything. They're also looking at Asia. But I liked how they don't treat Asia as one big blob.
That's a rookie mistake. People say, I want exposure to Asia. That's like saying, I want to invest in the Northern Hemisphere. Yeah. Australian Super breaks it down into 3 distinct buckets: China, India, and Japan.
Let's go through them. China first.
China is high risk, high reward. The insight here is you cannot invest in China from a desk in New York. You have to be on the ground. You have to understand the regulatory cycles in Beijing because the government can change the rules overnight.
Okay, so handle with care. What about India? Everyone's talking about India.
India is the growth story. The demographics are fantastic. Lots of young people, massive infrastructure build out. But the secret is out.
Meaning the stocks are expensive.
Very expensive. The valuations are high because everyone already knows the story. You're paying a premium to get in.
In Japan, I feel like Japan's been asleep for 30 years.
And that's exactly why it's interesting now. The story in Japan isn't growth, it's governance reform.
This sounds a little dry.
It sounds boring, but it's incredibly profitable. For decades, Japanese companies sat on piles of cash and ignored shareholders. Now, the government is forcing them to change. They're increasing dividends, doing buybacks. They are finally trying to make you money.
So, China for the brave, India for the growth, and Japan for the value.
That's a great way to put it. And it all acts as a diversifier against being too heavy in U.S. tech.
Now, the last piece of the puzzle is private equity. This is investing in companies not on the stock market. Australian Super says the game has completely changed here, too.
Oh, completely. For the last 15 years, private equity was kind of easy. Interest rates were zero, money was free. So the playbook was buy a company, borrow a ton of cheap money to do it, wait a few years, and sell it.
It was financial engineering. Buy low, add debt, sell high.
Exactly. But now, interest rates are not zero. The cost of borrowing is real. That old playbook is dead. You can't just leverage your way to a profit. Australian Super is saying that now returns have to come from actual operational improvements.
Meaning you actually have to make the company run better.
Imagine that. It's like buying a fixer-upper house. In the old days, you could just buy it, wait for the market to go up, and sell. Now you actually have to fix the roof and upgrade the kitchen to make a profit.
You have to do the work.
You have to fix the supply chain, improve the product, manage the staff better. It's about execution. It's not about how much money you can raise. Fundraising is down, by the way. It's about how well you can run the business you bought.
This brings us full circle, right back to the cars in Germany.
It really does. It's the same theme running through everything we've talked about.
Look at BYD. Why did they win in January? Execution. They didn't just have a concept car. They had physical inventory, a dealer network, logistics. They executed when the window opened.
And in the investment world, with AI, with private equity, the easy money era is gone. You can't just buy a ticker symbol or load up on debt. You need companies that can execute, build the data centers, fix the operations, generate the cash.
It feels like 2026 is shaping up to be the year of show me the results.
That is the big takeaway. Whether you're selling EVs in Munich or building AI models in California, the market has stopped rewarding hype. It's rewarding tangible, physical execution.
It's a sobering thought, but also kind of refreshing.
Yeah.
It feels like we're getting back to basics, just with much higher stakes and way more advanced technology.
Absolutely. And it raises a really provocative final thought for everyone listening.
Lay it on us.
Well, we're seeing Chinese companies building physical factories in Europe. We're seeing U.S. tech giants spending the GDP of a nation on physical AI infrastructure. We're seeing this huge shift to real assets.
Right.
So when we talk about inflation in the future, who really controls it? Is it the Federal Reserve?
You'd think so.
Or is it the companies that control the physical supply chains? If BYD controls the cost of transport for the middle class because they own the mines and factories, and if Google controls the cost of intelligence because they own the chips and the data centers, policymakers might find they have a lot less control over the economy than they think.
Wow. Who owns the pipes? Owns the prices? That is something I am going to be thinking about for a while.
It's the new reality. Power is shifting to the builders.
Well, we have covered a massive amount of ground today, from the autobahns of Germany to the boardrooms of Australia. Thank you so much for breaking all this down.
My pleasure. It is going to be a fascinating year.
And thank you to everyone listening. We hope this gave you a clearer view of what's really moving the markets beneath the headlines. Don't forget to subscribe and hit that like button. We'll see you in the next deep dive.